So my first question is, how many of you are parents of kids who are 0 to 7 years old? Okay. How many of you, so not that many actually. How many of you are aunts or uncles to 0 to 7-year-olds? Okay, and any grandparents in the room? Anyone who wants to admit? Okay, awesome. I love it. I love it. That's great. So we're Caribou, and this is a problem we're trying to solve. How many of you have been in this situation where you're at the airport trying to read a bedtime story to your kid and they can't see the book, you can't see them, it's impossible, they're completely unengaged, they're getting just kind of sick of this, and they get off the phone? How about this one? Have you ever done this at a Starbucks trying to read through a webcam? This is even worse. So, there's a more simple solution. All right, we help parents. Oh, you liked it. Oh, thank you. We love customer feedback. That is great. So we are a company that helps parents and extended family read bedtime stories to kids when they're far away. We know that that's something that people often do, and we wanted to make it easier for them. So we made a Kindle meets FaceTime, kind of had a baby, and they made Caribou. We have a ton of amazing features on the app. Everything that you do is in real time. So you draw in real time, you read in real time, all the pages turn in real time. We also have a pointer so that the child can follow along. You can magnify if you're on your phone. And obviously, you're simulating in-person story time on the call. We have tons of partnerships and endorsements. Some of the largest publishers in the world, Santillana, which is one of the largest Spanish language publishers, Mattel, who has all of the Thomas the Tank books, Angelina Ballerina. Those are great partnerships. Tons of independent publishers as well. And we were featured in the Apple iPad campaign in 2014 as a great use case for something that really brings families together on an iPad and helps families communicate with each other. We've also been featured in a ton of different press articles. Some of you saw us in the Miami Herald recently. Thank you, Nancy Dahlberg, for writing about amazing Miami companies. And we also are global. We have families using Caribou in over 190 countries. We have over 200 books on our app in 6 different languages from over 20 publishers. So the market is huge, and we're in it. We are a small but mighty scrappy team. I am Max, the CEO. Alvaro is our CTO over here, who's going to wave from doing all of the tech. I have 15 plus years in education, and he has over 10 years in engineering. So we complement each other really well. And when you think about the type of people you want building apps for your children, we are the team.
Now for the moment you've all been waiting for, I'd like to bring up Brackeen, who will serve as our moderator today, and he'll introduce our panelists. Oh, you're
Hello. How I sound? Hello, Miami. So first, let's give ourselves a hand for being one of the most amazing, dynamic ecosystems in the country and in the world. I'm a big believer in everybody here. No better place to start a company than Miami. I'm a firm believer in that. And we're going to learn about not just starting, but then scaling. And I'm going to bring up an amazing panel. I'm going to let them do their own kind of amazing intros. But the thing about me is, if you guys aren't you're too humble, I'm going to call you on it. And we're going to drag it out. We're going to get until we can get the unhumble intro for each of you guys. So first, we'll have Weinraub from LiveNinja. Next, Juan Molina from CareCloud. This guy's got some great stories for you. Right? And I don't want to miss the last name. Emiliano? Abramzon. Abramzon. From Nearpod. So guys, thank you.
welcome.
Let the crowd know kind of who you are and how you got here, why you're up in this stage today.
Sure. My name is Weinraub. I'm co-founder of LiveNinja. LiveNinja, we're a startup based in the Wynwood area here in Miami. Currently 13 people, but we're growing. We were recently acquired by a publicly traded company called IDT. You know, you know, LiveNinja started off, we were a bunch of different things. We went through a few what are called pivots, is like the industry buzzword, but I mean, I call them fuck ups, but pivots is the politically correct, I guess, term for it, the buzzword. So it's been an interesting journey. We raised a few $1 million to get here. I think like the exact number is we raised $4.2 million throughout the life of the company. So I have a little bit of experience, what it's like to raise money here in Miami, and try to scale a company here. So hopefully I can add some value to the audience on that.
Pretty good, pretty fair. Yeah, pretty good.
Is it okay?
It was.
All right, great. So I'm Juan Molina. I currently lead strategy at CareCloud. We're a venture-backed startup. We've raised, you were asking me earlier, and I was chatting with co-founder Mike, who's here as well. I'm on the founding team, and when we were outside, I was trying to ask him, like, you know, how much have we actually raised? And the number's about $105 million. So we've gone through, we just raised our Series C. We announced that in November of last year was a $31.5 million raise. You know, we're building the next generation platform for healthcare. You know, when we all go to the doctor's office today, we're kind of mired by old technology, old workflows, et cetera. So what we're focused on is really building kind of this next generation, and we're really uber focused on delivering the best, most beautiful user interface for doctors and for their patients. So whether it spans the financial and administrative side of the business or the clinical side or even us as patients, the one that's always forgotten, that patient engagement side, that's what we're really obsessed and focused at doing at CareCloud.
You know you raised a lot when you can't remember what that amount was.
Yeah.
I'm glad I went before him.
Yeah, I should have put you at the end.
My name is Abramzon. Can you hear me okay? I'm one of the founders at Nearpod. Nearpod is an ad tech company. Our mission is to help teachers engage students in these connected classrooms. We are a mission-driven company, but a for-profit company. We created a company 5 years ago here in Miami, and we were fortunate enough to do a seed round in Silicon Valley, about $1.5 million, and then we did a Series A, a combination of Silicon Valley and Miami for another $7.5 million. And we just, like yesterday, closed the Series B. It's not announced yet, so I cannot disclose the amount, but we're doing pretty well.
You just announced it.
And I was so excited, I forgot to even say why the heck I'm here and who the heck I am. So yeah, my name is Brackeen, CEO of a company called Kairos. We're a facial recognition company based here in Miami. And today it's definitely about these guys, but again, we're just so proud and so happy to be here in this community. So this is really about kind of the post-Series A and growth and scale, but we certainly should spend at least one question talking about how we got from 0 to that kind of Series A. And especially with that Series A crunch, how tough it is to raise money in that space. Can you guys talk a little bit about that kind of 0 to 60, let's say?
I mean, my story is very typical. We first got 100 no's, and we toured the country with our idea. And at the beginning, we ended up self-funding the company. We got a very rough beta that we tested in the classrooms, and we saw the reaction from teachers and students. And we believed in our product so much that even after a few months of not being able to raise a seed fund, we decided to put our own money. And then once we got traction in the product and they saw teachers blogging and tweeting and doing what we wanted to do with the platform, it was easy to get the seed round. And then that was milestone A, and we got product market fit. And then they said, well, but you're never going to be able to get revenues on this. And then we started to get revenues, and then it was easy to get a Series A. But at the beginning, it was not easy at all. And 100 stories. And I think we are a good case of a combination of Silicon Valley and Miami, and I can answer any questions you have, but we first tried to fundraise here in Miami, and it was very tough. We went west, and somebody believed, and then all of a sudden, everybody started to believe. So that was a huge help, to have a big name in Silicon Valley that invested, and then everything falls apart.
Yeah, I mean, I think our story was interesting. It was similar in the sense that we spoke to lots and lots of people. I mean, I think the difference for us was we didn't have a product. We had a pitch deck and we had a vision, and we said, we said, look, this is where we want to go. This is who we want to be when we grew up, right? Our kind of big, hairy, audacious goal was to kind of re-platform the entire industry. So we knew early on that we were going to have to raise a significant amount of funds to make this happen. But our seed fund was really angel investment, and it was almost exclusively done here in South Florida. So that's how we did it. And we actually did. I remember when we were going for our Series A, they were quite surprised at how large our seed was. We had an $8 million angel round, which is pretty large, right? And then that kind of leads to what we did next in the Valley. Our thought was always from the very beginning that we were going to have one foot in Miami because we're born in the 305, but we knew that we wanted to have the other foot in Silicon Valley. That was incredibly important to us. We realized that the investors that were out there, for the most part, really understood how to scale a business, specifically a technology business. So we focused on getting that seed to get the team, kind of the core application, built out, and then we went out for Series A.
And what year was that $8 million seed?
So that started in 2009.
2009.
Yeah, so we were founded, I guess, officially January of 2009. And we started really bringing in capital in the June 2009 timeframe.
That's still a big seed in 2017. So.
Yeah, it was a big seed.
Yeah, I mean, we didn't, when I started the company, and I didn't go out saying, I'm starting a company, I want to raise some money. I really started the business first, tried to figure out what the hell I was doing, and then went from there. Started the company, in my spare bedroom, just myself. I had limited technical knowledge, but I had saved up some money. So I was looking to start this idea. I was really passionate about it. So I looked for a developer. I found a freelance developer in Romania to help me build the app for about $5,000. Once I built this app with this person, it was okay. It was an MVP, if you even want to call it that. Hardly worked, but it was enough of a proof of concept to get some customers and some revenue, and able to prove it out. And when I recruited my two co-founders, Emilio and Alfonso, they came on with a caveat. They said, sure, but we got full-time jobs. We'll give you Tuesdays and Thursdays. We'll moonlight with you. We'll spend from like 6 p.m. till like midnight or 1 a.m. and we'll hang out. We'll try to build this app, the non-Romanian version of the application. So we started building the app, and it kept getting better and better. I asked the guys. I said, really appreciate you guys spending two nights a week, but we need to devote more time to this. How can I get more time? And they said, pay us. Then I realized I had to raise some money. And that's when it started. Okay, I need to raise money. How do I do that? I didn't know many people in the tech scene. Again, this was 2011-ish. I knew one person, and his name was Brian Breslin, who founder of Refresh Miami. So I pinged Brian completely cold. What's going on in the scene? He pointed me to Incubate Miami, the only kind of incubator accelerator going on. Mark Billings back there. Hey, Mark. Absolutely. So I went there just to kind of get in the middle of the scene, and I applied to get into Incubate Miami, but they were in the middle of their batch, so they didn't let me in, but they said, you know what, you could hang here for the day, hang here as much as you want, et cetera. And it just so happened that one of the days I was there was an angel investor speaking that night, and his name was Marco Ghiberti. And Marco gave a talk about how miserable it is to be an entrepreneur, and the stress and the aches and the nights of terror and the nights of sweat, but then he concluded with how rewarding it is. It was a good talk by Marco. And I remember literally, like, he was leaving Incubate Miami, and it was like one of those moments, he literally got in the elevator, one of those moments where the elevator door's closing and you stick your hand in the elevator and you're like, there's a 50% chance I'm losing my hand, but I'm gonna do it anyways. It was like one of those things, and I literally was in the elevator with Marco giving him a literal elevator pitch. And I think he was just annoyed with me. He's like, sure, here's my email. Maybe we can meet for coffee. And I emailed Marco, and thankfully he met me at the Starbucks on Key Biscayne. And eventually another meeting with Marco, and he wrote the first check into LiveNinja, and that spawned a little bit of a seed round for us. We applied for SuperConf, which was one of the only software conferences happening in Miami at that time, when we were one of the winning companies there. And that got us a little bit of momentum. And I told Emilio and Alfonso, I think we can do something here. If I could raise $500,000 to start the company, would you guys quit your jobs and do this full time? And they said, absolutely. Go raise $500,000. Sure. So I was like, all right. And from April 2012 to August 2012, I raised a $500,000 seed round, and we started full-time operations of LiveNinja in August of 2012, and that was the essential first capital in. And again, we realized that we weren't able to scale the initial model of LiveNinja, but we were able to get a little bit of traction with it. We were able to build some really, really great technology, and we ended up attracting business customers. We weren't a B2B company, we were a consumer company. And as we scaled B2B companies, we started generating revenue, we got some household names as customers, and that's when it became easier for us to raise money.
And I think it just goes to show that there's like no path, right? That's the right path.
Right.
There's so many different ways to make it happen.
All three stories were so different.
Yeah.
Absolutely. Actually, Marco's one of our first investors as well, and I think it's where they're saying for the angel investors in the room, you got the people up here don't exist. They don't get a chance to sit here and tell this story without those early checks, right? So angel investors, thank you for you're doing God's work, and keep doing it. Keep writing those checks. Okay, so now we've all, you started in all three cases. And then there's this kind of Series A looming where even at the times you guys all raised, it's tough, and it seems like the bar gets further and further away. You'll meet an investor and they'll say, if you just do this, I'm definitely in. And you do that and they say, if you just do this, I'm definitely in, right? And also for those that don't know, sometimes investors have a certain amount of money in the bank that they've already kind of deployed. And so as the years go on, they can't take early bets on companies. So they've got to get that money back. They don't always tell you where they are in that, in that process.
That's an important question to ask.
It's an important question to ask, exactly. So how did you guys go about the Series A, the planning part of it, the execution of it, and then how did it eventually work out?
Sure, I could start. I'm one of those entrepreneurs. I don't like to get hung up on like the semantics of like seed and seed 2 and Series A and Series B. I'm just raising money. You know what I mean? I need money, and I like the investors to label it however they want to label it. I feel like sometimes entrepreneurs, they put themselves in a box when they say I need an A round, because like that comes with like certain baggage, those terms. Oh, yeah. So for us, we were raising some additional funds. As we were just getting started, this was right at the time when we started having some brand names, some household names as customers. Apple became a customer, HP became a customer, et cetera. And it basically just, kind of grew. We were raising additional capital. We said, okay, we were going to raise this amount. And thankfully, there was more demand, for the round than we anticipated. And I think that's also a good tip for entrepreneurs. You oftentimes want to say you're raising less money and let it become oversubscribed versus trying to shoot for a larger round and then having it appear the optics that you
didn't hit your target.
Exactly. Because investors, it's a herd mentality. And the hardest yes you're going to get is that first yes. Yeah. Once you get that lead investor, then the rest will follow. So we were very fortunate that Brad Harrison from Scout Ventures, he led our Series A round. He set the terms of the round. And once we had that first institutional check that set the terms, that really gave us the validation to continue raising the round. And then a certain size round, I think we set out to raise $1 million. It turned out to 1.5, then it turned into 2, and then we started to get emails. Well, can you please just try to squeeze us in? And it was just like it was the best position to be in. But I think it was because we started low, and then the perception was we let more people in versus started high. So that's kind of how it evolved for us. Yeah.
I think from our perspective, with that large seed that we had a little bit of runway, right? But not that much runway that you would think, just because of what we were trying to do is pretty ambitious. So we knew pretty early on that we were going to have to do that A, and we attacked it very similarly. My background and a lot of the folks on the founding team were kind of the sales-driven culture, if you will, and we attacked it very similarly to how you would attack a pipeline, right? So we did have some really great some good luck. I think you have to be good, but you have to be lucky sometimes at the same time. So we won IBM Smart Camp back in 2010, and I think that really helped us. We were awarded an award at Always On, which was out in the Valley. So like I said, we really had this focus on being 1 foot in Miami, but 1 foot in Silicon Valley, and we did that early on, and that is what led to all of these introductions, right? So I think you nailed it. We were very, very fortunate to get Norwest Venture Partners as one of our first investors, and they set the price, and Intel Capital came in right after that, and we met with over 50 different VCs that first day, and I don't recommend that, right? Because what happens is that, and I'm sure we'll talk about this, but remember, when you meet with 50 VCs or 60 or 70, right? The next time you go raise money, you're going to meet with some of them again, and they're going to have your pitch deck on their desk from your Series A, right? So we just raised our, an oversubscribed $31.5 million round, as I mentioned, and we brought in kind of a traditional VC and then also 2 strategic partners. But of course, we went out to the Valley early on last year, and I never forget, I walked into several VCs, and they had our Series B pitch deck. And they're just opening it up, and they're like, well, how are you hitting on this metric? How'd you do here? Did you hit these numbers that you said that you were going to hit? So, it's a little, refreshing, pun not intended, but to have that kind of, thrust upon you when you're trying to raise that money. So I would caution that, be very strategic and very focused on who you want to go out to. More is not necessarily better, right?
Yeah, the other advice that I would add is when you have your pitch ready, don't go to your best contact first.
Yes.
We had our pitch ready, and then we chose some people that we knew they were not going to invest, or we didn't want them in the board or something. So we go and pitch them to practice, and they gave us feedback, and we tweak it a little bit. So we had about 5 to 10 meetings before we were ready for our best investor possible. And then obviously what they said before, the luck factor, it's got to be there. Yeah. We pitched our first seed lead was New Schools Venture Fund out of Silicon Valley. We pitched to them, and they said no, and then 9 months later they came and said yes, and they led the seed round. And it happened that night they have a gala dinner, and one of the donors of the New Schools Venture Fund is Laureen Powell Jobs, the widow of Steve Jobs. And we had an opportunity to present our pitch to her directly that night, and she wrote a check to us the next day. So we were at the right time there, and we were lucky. And then after that, everything was much easier because Laureen.
I bet.
But again, at that time, when we got to Laureen, we got the pitch nailed down because we practiced a lot before with other investors.
Yeah, and in fact, I was going to make that point. Definitely serendipitous that she was there, but you still had to deliver, right? You still had the pitch deck, you had to give a great pitch, and whatever you said in that moment moved her. So that kind of serendipity has to be also engineered, right?
Yeah. I mean, just for our Series C as an example, we went through 40 iterations of it. Right, so there's a Dropbox folder. It's like V34, V35, or for this audience or that audience. And we pitched it internally to ourselves and really tried to poke holes. Mike and I and the team and our current CEO and others. We literally would print them out and put them up on the wall and say, does this story arc make sense, right? And your Series A deck is so different from your B, which is so different from your C, right? Series A and seed is all about vision and execute, that you want to have that, you want to do something great. You never lose that. But Series B is where you start kind of showing that traction and scale and the ability to unlock that scale and build that repeatability. And then Series C is like, you better show that you have traction, right? Because if you don't, it's a much different conversation.
Just to piggyback on those things, I think, one of the things that I learned that was really important is, Mark Suster, from Upfront VCs, he has a great quote that says, investors invest in lines, not dots. And he means by that is you have to start meeting with investors early, and they have to start getting to know you. Yeah. And basically what they have to do is they have to connect the line. Is the line moving up and to the right? In whatever fashion. That could be revenue, that could be traction, et cetera. That's how they make their investment decision. You can't show up one day, make the pitch, and you're going to close it. You have to build relationships, and that's a process that you really can't rush. So you really want to meet people early and just know that's part of the process. I mean, we raised money from people that told us no 3 times and then ended up investing in us because we were able to show progress. So just realize that as you're getting turned down, that is part of raising money. You have to just know, feel that, in your gut. I like to think every time I heard no, it's it's a punch in the gut, but that feeling when you're working out and you feel the burn, but you actually embrace it because you're getting stronger. that's how you should take rejection. You should think of it like that. And there's another quote. This one is by Fred Wilson. If you're looking for advice, ask for money. But if you're looking for money, ask for advice. So basically what he means by that is if you want to raise money, don't be in there, hey, I'm looking to raise $5 million. Meet an investor, target them, be like, hey, I'm not raising money right now, but I just want to maybe, so if you have 5 minutes, I know that you're interested in this market. I'd like to hear how you're thinking about the market. Just run some of our ideas by you. And then maybe when we're raising money, maybe we could talk later. But right now, I just want to get to know you and hear what you think. Then the investor starts to think, okay, they're open to my ideas. I can actually partner with this person. We can actually work together. And then they end up pitching you. So let me know when you're raising money.
Yeah.
So just a tip, it's the subtle things like that that could end up making a difference.
Yeah, one other comment is don't try to push yourself with the milestones too high so that will put you in a bad position later on. I think something we did pretty well was to be conservative on the milestones from the beginning, 4 years ago. And we said, by year 2, we're going to do this. And it wasn't crazy, but it was, a big milestone. And then we delivered. So when we finished the seed and we delivered what we promised, Series A was there because they said, okay, you are the guys that deliver what they said they're going to do.
Right.
And then we did the same going on. And we always try to beat that milestone that we promised. But the milestone is not that we're going to grow from 1 to 20 million in 6 months. It was very reasonable. So that's my advice. Be very reasonable with the milestones. You don't have to kill yourself because that's going to kill you later on.
Yeah, because they will have your Series A deck on their desk when you go pitch them again.
Oh, for sure.
So
I saw
that's great advice.
I saw a funny startup meme this week. It said celebrating a funding round is like buying a condom and celebrating before a date, right? Like, there's still so much to do, right? And so let's talk about that. You've got the money in the bank. You actually have the chance to make a lot of mistakes.
Oh, yeah.
Right? And you've got to be really kind of disciplined to not make those mistakes. So
yeah.
Tell us about kind of post-money, how that worked for you guys.
Yeah, there's a quote that I love that's kind of like that. It says, congratulating an entrepreneur for raising money is like congratulating a chef for buying the ingredients. Yeah. Like you haven't cooked anything.
That's much nicer than mine.
Yeah, mine's more tweetable, right?
Yeah, absolutely. Okay. My mom follows me on Twitter.
So yeah, definitely, it's really, for the folks out there that didn't raise money, I actually would challenge you, like, life is actually a lot easier if you can get by without raising money.
Yeah.
It's not glamorous at all. It's not like in The Social Network, the scene where they're popping bottles and they're all excited. No, like I remember when I...
What?
Yeah. Well, maybe at the $100 million round, it gets a little bit different.
Just kidding.
All right? Yeah. A little bit different. Then it's like Dom, No, for me, like raising money is like, oh, thank God I can make payroll.
Yeah.
You know what I mean?
Yeah,
like
sure.
That kind of stuff. And not only that, but you think, I just raised all this money. Holy shit, now I got to do a 10x return on this money. And all like entrepreneurs, you glamorize about, like we glamorize about being our own boss. The second you take in money, you're not your own boss. You might have the CEO title, but you answer to people, and you have to have a return for their capital. And trust me, they will call you, and they will ask for updates, and you have to be able to manage these expectations. And like managing investors and a board of directors and expectation, that's like an art form in its own right. That I still have a lot of learning to do on that, but. Yeah, post money, it's this whole different ballgame. You raise money, you have a business plan that's set out when you raise the money, you try to execute that. 9 out of 10 times, you quickly realize that that's not the right business plan. You work with hopefully your new partners on moving in a different direction. You got to get the right partners on board. Maybe we could talk a little bit about how we vet our investors later on and things like that. But post money, that's when the real show starts. And that's when the pressure really adds on. Like if you thought raising the money was hard, spending it the right way and getting results 10 times harder.
It's even, I would say, it's you can maybe rest for a day.
Yeah.
And it happened to us. We signed that on October 31st of 2016. We all kind of like did the high five and was like, oh crap, now we have to go do this stuff that we said we were going to do in the C, right? And in that pitch deck. So that's when the real work begins, and it's daunting, it's overwhelming.
The advice that I will add here is select your investors very well. Not all money is equal money.
No, definitely not.
You need to feel the fit in your mission, in what you're doing, that you're going to get a loan. It's a long-term relationship. You got to see them every quarter, and you want advice, you want coaching. So don't take any money because it's just money. Make sure that you look at the investors as somebody that is going to partner with you. And the better you get along with the investors, the better you all going to succeed.
And I think it's okay to ask, right? Like, what's your time horizon? How do you guys think about investments? You know, one of the things that we did and why our Series A, we chose who we chose was because Norwest, you know, single limited partner, Wells Fargo Bank, very different than all of the others or have different kinds of LPs. Intel Capital invest off their balance sheet. They were long-term, very patient investors, right? So we knew that this was something that was going to take us a long time versus somebody who's looking for that exit, whose investment thesis is all around a quick flip or something like that, or their entire investment thesis is all around selling it to PE or whatever the case may be. Yep. So look at who they invest in, right? If they're not an investor in your sector or your industry, that doesn't mean that they are necessarily a bad fit, right? Because there are different types of fit, long-term horizon versus short-term, or if they're in your industry or sector, that's important. But you know, the advice that I would give you is exactly what you mentioned. Not every investor is suitable for your venture, what you're trying to accomplish.
Yeah, and it could be intimidating also to, you know, like a lot of entrepreneurs, first time raising money, you think, okay, the questions come one way. No, really you should feel empowered to ask them the tough questions as well. You know, Brian made a great point early on, like what cycle are they in their fund? That will dictate how they operate as a board member, right? Are they looking for an exit real quick because they have to prove to their LP so they could raise their next fund? Or is there a different, more long-term horizon in the fund that they could be more patient with you? Really, really important questions to ask. And you know, when you start the venture capital process and you start raising money, you'll go into a due diligence process. The investor will put you through a due diligence process. They'll ask for references and all this stuff. You should ask for references as well. You should do double the due diligence on the investors that they do on you. One of the things that I learned to do, which was really effective, you ask the investor for their references, right? Of course, when people ask for references, they give you the 3 like shining, you know, testimonials that you get, right? So if possible, you research the investor. Some VCs will have a portfolio page. Of course, sure, talk to the 3 referrals that they give you and see how things went. Those are usually the success stories. But give a call to 3 of the portfolio companies that went under, that failed, and ask how that investor behaved when times got really tough. That's the real testimonial, right? And that'll give you some transparency into that. So feel free to push back a little bit. This is your company. Investors invest in 50 to 100 companies. This is your company. You should really feel like if you're going to let this person invest, you should know everything about this person and how they're going to do business once you guys are partners.
I couldn't agree more.
So people is an important part of all this, whether it be investors, board members. We haven't really touched on employees either, right? So you raised a round, you're probably going to maybe double your staff, maybe even more, right? How do you find the right people that are going to work for your group? And we'll start with that.
Sure. You know, also, you know, managing expectations, you know, and the different phases of a company. You know, you start off, you're very scrappy, you know, you can't afford to pay out raises, but then you raise more money. Obviously, people are entitled to raises. They're entitled to better compensation. So you got to learn how to take care of your employees as you get more funding. And then obviously recruiting. I mean, we were just talking about this before the panel. Fred Wilson has a great post that he just wrote a few weeks ago that says basically throughout the life of a company, as you scale it, you're going to turn over your staff about 3 to 4 times. The people that you start the company with are not going to be the people that you necessarily scale the company with. And that's okay. That's part of the process. So just kind of be aware of that and look in the different times that you know, like if you need growth and you need revenue, then you want to start looking down the sales route and things like that. If you need early product market fit, you want to look for people that have good product sense. So being aware of the metrics that you need to hit and how to get to the next round, that's very important. And when you raise funding, it sounds like kind of straightforward and cold, but that's really the game. You're raising more money at a higher valuation than you raised before. And when VCs put in money, they expect that to happen. By all means, when you raise money, you're on the express train, and there's no getting off the express train. If you want to be an entrepreneur and you want to take your time, and you could live a great lifestyle, you could have a multi-million-dollar business being bootstrapped, but if you want to raise money and you want to go for like having a billion-dollar company, you are definitely on the express train. Once you start taking in millions of dollars of capital, the investors in that round are going to expect you to raise more money and more money at a higher valuation until there's a liquidity event, either an exit or an IPO. So just be like, realistic with yourselves that this is the path, and I need to find the right staff and the right team that could help me get there.
And I think the other thing too is just be honest, right? I think it's important, and at any time, and still today when I interview anybody that's coming on board at CareCloud, and this was especially true, I would say, kind of earlier, where, and I tell them, when you work at CareCloud, when you work at a startup, the walls are shaking, right? Like things are there, it's very chaotic. And it's interesting. I always look at different people's backgrounds, right? So if they came from a large, kind of Fortune 500 company versus, a startup environment, are they the right fit at the right stage of your organization, right? Because sometimes you need the people that can kind of set out that strategy or think kind of higher level, more consultancy type, folks, right? Maybe in different stages of the organization. But when you're young and early and growing, you need the people that are very scrappy, that are incredibly resourceful, that can do 5 different things, that can wear multiple hats. And sometimes those people won't be there, 3 years from now. And like you said, that's okay. But I think it's really, really important to actually be incredibly honest with those folks that you're bringing on board and letting them know, look, we don't have a process for this. This doesn't exist. You're going to be building this from scratch, right? And how does that make you feel? How would you react? And I tell them the story of when we first started CareCloud, we were wearing 1,000 different hats. I was picking up the phone calling and leading a team and building out the sales, the demand gen engine with Mike and, all these different things. And whatever we had to do, we just did, right? So not everybody's built for that. Our CEO has a great saying that he says, you need a little crazy in order to be an entrepreneur and to be at a startup. If you're not, there's something wrong with us. If you're an entrepreneur, if you're at a startup, but that's okay. That's what makes you great. Yeah. So look for people that are like that. And what I would say is, we went through a phase where we were looking for those people that had like that perfect industry experience, right? And we went for those types of folks, and some of them worked out, some of them didn't. But what I would counsel everybody is look for passion and intelligence, right? And resourcefulness. Because those are the people that are going to take you to that next stage, right?
Any thoughts on people?
It's a challenge. People, we went very rapidly from a 5-people company to a 60-people company today, probably going to 100 in the next 12 months. And you need to maintain a culture, you need the values of the company, and you incorporate in a ton of people. In the last year, we just hired 35 of the 50-something employees, and they're all new, and they need to fit in our culture. They need to get trained. They need to get on board, and they need to train other people that are joining because now they are the old guys. Mm-hmm. So it is a challenge. We thought that product market fit and revenues, and that was the tough part, but managing the team and onboarding the people, I think is probably the biggest challenge. Yeah. But I echo what he said about the type of personality depending on your stage. And yeah, at the beginning, I was doing fundraising, selling, doing product development, talking to the engineers, everything. And the people we hired at the beginning were kind of like that. Yeah, go to a trade show, then go to the customer success, then go to... And now we are hiring more, like we are hiring a CFO. Well, the CFO needs to be a true CFO. And then we hired an engineer that is looking at the architecture. Well, now we have 5 million concurrent users. Needs to be a true engineer knowing about architecture, right? So now we are being more specified about what we hire. At the beginning, there was sort of more generalist. And the ones that came saying, oh, you told me that I was going to do only customer support. Yeah, that's not the right fit. At that stage, right? Yeah. We did a little bit of everything.
So I think I'm doing a great job asking great questions. However, really all the value in this conversation is going to come from the folks in this room. So let me just pause for a second. Let's take any hands or questions. And I think hearing your questions will be more important than what I'm just asking.
Yeah, so I think, I appreciate the question. So, we have a bunch of different product lines at CareCloud, right? So, if you look at our website today, right, we look like an apps and services company. But at the end of the day, that's not who we are, really, right? And it's not really what we want to be, I guess, when we grow up. We really are building a platform for healthcare, right? The ability to allow other third-party developers to build apps on top of our platform that kind of connect the entire ecosystem. But it didn't make sense for us strategically from day one to say, look, we're a platform company. We're the Force.com of healthcare, right? Because one, we had no traction. Two, we had no customers. And we needed to keep the lights on, right? So what we did is we said, okay, how do we become the first consumers of our own platform, in essence? How do we eat our own dog food? And we built, the first thing we did was we built a practice management, so the financial and administrative system of a medical practice, and the revenue cycle management service piece, which is not 80% gross margin like you find in most SaaS businesses. It's more like 50% gross margin, right? And early on, it's more like 30% gross margin. But what we did is we said, look, that's the fuel that will enable all of this other growth. Now, that kind of business on its own is a very successful business. We have companies in our market that have a $5 billion market cap, right? That basically just do practice management, electronic health records, and revenue cycle management. But we were very focused on saying, look, we know where we want to go. We know who we are and what we want to be. Now, if we just become a very successful PM, EHR, and rev cycle company, and we hit it out of the park, we're going to all be very, very happy, and our investors and everybody will be happy. But we have an opportunity to do something revolutionary, right? But we knew that we had to get there somehow, right? So I think for us, it was about how do we get that short-term revenue to keep the lights on and to kind of know that we were going to go out for an A and a B, eventually. I don't know if that answers your question, but. Sometimes it's about staying alive, right? And it's also about not being so, not allowing yourself to not pivot, right? Sometimes companies say, look, we're this one type of company and that's all we're going to be. We haven't luckily had to do that pivot too much, but we've had to really adjust our thinking and how we go to market, right? And who we actually try to attract as a customer versus being everything to everybody. A very good lesson for us is that I would say early on we went very broad. So we were building electronic health records and practice management software for every single state in the country, in every single specialty, 52 specialties, 80-something subspecialties, right? So we went a mile broad, and an inch deep. And what we did a couple of years ago, about 3 years ago, we said, look, let's really focus the business and let's really focus where is our product market fit and where can we really delight our customers, right? But at the end of the day, it was all about getting that traction early on.
So see if we can go rapid fire here. Let's see a lot of hands.
Thank you so much. I appreciate it. Thank you for your amazing experience and your stories. They inspire us all. And I guess I can't leave that question without asking you.
Where's the mic? An
open question to all of you who have raised millions of dollars already. How do you leverage that talent here in Miami? We know it's an ecosystem that has been growing, but sometimes when you get to that level of investment, maybe you attach or your business model is attached to other city because of many things. How do you actually leverage that and be still passionate about Miami? How do we actually maybe engage on better serve all the ecosystem? What's your experience on that when perhaps those investors tell you, you know what, maybe we should move here or there, but you still want to stay in Miami?
Sure, I can start. So I think location was more of an issue 5-10 years ago. I think more and more investors are becoming location agnostic, and I think traction is location agnostic. If you could show that you know how to turn 50 cents and make it $1, money's going to find you. And there's enough money out there nowadays. There's a lot of money in the venture ecosystem that is location agnostic, that doesn't require a company to move, from where they're founded or where they're based, that, there's enough of a market for you to raise that money. However, there are some challenges here in Miami. There's no doubt there's not as many institutional, venture investors as a Silicon Valley, as in New York. You got to get on a plane. You got to travel. No doubt, that's part of the gig. So you have to expect that. But just know who you're targeting. Make sure you're targeting the investors. Like, your time is the most valuable. So make sure you're targeting the investors that you see their portfolio, that they're not just investing in Silicon Valley, they're not just investing in New York. Ask that question early on. And if they do invest all over the country, all over the world, then leverage that. One of the things that I found, if you want to target investors that are large institutional investors that are open to investing in ecosystems that are not as mature, one is, because a big deal with venture capital investors is, should I be able to travel once a quarter for the board meeting? It's a big deal, right? So if the investor has roots, if they're from South Florida and they have to come here anyways for their family, they're more likely to invest. As weird as that sounds, they're more likely to invest anyways. They have to be here for Christmas. They have to be here, for their, spring breaks and things like that. So much more open. The other thing is that if they're already invested in a South Florida company, they already got to come for that board meeting. So I'm more open to investing in another South Florida company because I'll already be in town. Sounds weird. It works. So just a couple tips there, but I think, that was the case more so 5 years ago, and as we, move forward, location is becoming less of an issue, at least I feel. If you have traction, money will find you.
Definitely offer the wintertime board meetings in Miami and then other ones wherever they are.
All right, hi, my name is Emmanuel Adoge. I just have a quick question for you guys. Last week I was with Mary Biggins with ClassPass, and she said her biggest regret was giving so much of our equity away so early, trying to raise money. And we're right here. You guys are saying, run out and raise some, funds to keep you going. So, there's a kind of irony in that, So my question to you guys is it really that, what does it take to give out so much equity of your company so early? Do you guys have any regrets doing that, giving so much away, or how does that work?
Go ahead.
Yeah. Everything in life is a trade-off. And the best advice that I can give you is mind your timing. The best you do the timing of the fundraise, the less equity you're going to give out. So, for example, we did the seed after we put some of our own money and we had proved traction. So the seed had a very interesting valuation. And then we used the funds as much as we could, and then we extended as much as we could until we get Series A, but without being too tight that we were desperate for the Series A. So the timing was perfect, but that we could leave 2-3 more months, but we were not desperate. And then at that time, we got revenues already, and the valuation was big enough that we didn't dilute ourselves too much in the Series A. But to your question, yes, you get diluted every time you do a round, obviously. But that's part of the game, and it's a trade-off that you need to leave. If you are fine with that dilution, go for it. If you're not, keep working until you feel comfortable. The more milestones you achieve, the less you're going to get diluted.
Yeah, and I would agree. I mean, I think timing is incredibly important. Don't raise money when you're about to run out of it. Is I think an incredible lesson. You're always really raising money. You're always really you're not always raising money. You're always meeting with prospective investors. Is a better way to say it. So the best time to raise it is when you don't need it, right? But when you have a concept of this is what I need to unlock scale, right? So then when you do finally realize, okay, we're probably at the point, and it's not too late, down the line, you can just make those phone calls and make that happen, right?
I'll just add one quick thing. I think self-awareness is really important. In the early stages, you're considering to give away equity. Like, ask yourself, do I want to build something where I'm raising millions of dollars of venture capital and I have to just be attached to venture capital, that machine to keep me going? If you're asking yourself, do I want to create $1 billion company? You might say yes to that question, and there's nothing wrong with that. If you want to create, a business that's self-sustaining based on revenue, and you want to be scrappy early on, and it's important that you want to own 100% of that, and you can vacation whenever you want, and be your own boss, nothing wrong with that either. It starts with self-awareness on what you want to build. Don't just go raise money because you're reading it in TechCrunch that other companies are. This is your business. You run it how you think is best for you.
Yeah, I mean, I can tell you from our perspective where we didn't, our footprint was always U.S. first, right? So, I think there was an education that we had to give to those investors around, Miami's not a banana republic, right? I think there was a lot of education we did early on around, what we were trying to build and how we were going to go national day one. They asked us to move out to the Valley, and we said no, right? We said we wanted to stay in Miami. We were from here, so I can't comment specifically on international, but I do see that, in kind of they don't really understand Miami being as the capital of Central and South America. But I think it's our opportunity to educate them. VCs don't have all the answers. They don't know everything. And oftentimes what we find is that they'll take meetings or they're meeting with us to really try to understand markets and understand what's happening in certain ecosystems as well. And we think that's very important to kind of have that dialogue with them. But.
Yeah, we share the same story. At the beginning, they were confused. I mean, when we go to the VC after a few months, they say, "Wait, you were the company from Argentina, right?" No, I'm Miami. For them, it's kind of the same. But it's part of your pitch, right? Mm-hmm. By the time we finished the seed and we went to the A, and we showed them everything we've done, I said, "How did you do all that with such little money?" They are the Silicon Valley numbers that every engineer is 350,000, 250,000, the office and everything. Here you get a lot of things done with less money. So once they get through that, they say, "Oh, not bad to have an office in Miami." But obviously we went through, you need to move to Silicon Valley. How are you going to do it in Miami? It's not possible. So we ended up having 2 offices. We have an office in Silicon Valley, an office here. The majority of the people is here. But we had to open an office there.
Yeah, growth hack.
Yeah.
Hi. Sorry. Yeah, we have an interesting problem. Our investors have asked us for terms, and we do like a sober living facility along with VR addiction therapy, and they're conflating the two things. They're traditional real estate investors. They have a certain formula, a cap rate they go by. We're a cash flow company. How do you get them to convert them over the hump to see the big picture about technology and the value it aspires?
Yeah. So this is actually, it's an interesting question because we have an issue or a very different business model than your traditional SaaS business model, right? So your SaaS business models, for the most part, are 80%, gross margin, right? Recurring revenue. Well, we offer SaaS software and a business process outsourcing solution as well, which margins are not like a SaaS margin, and they don't get that. They don't understand the difference. So actually, what we did in our Series C was if I think about the deck itself, that slide talked about these types of companies that are traditional outsourcing BPOs, what their margins look like, 30% margins. And then on the other spectrum was these types of companies that are SaaS companies whose margins are 80%, right? But we're here, right? And we're neither this nor this, right? But here's a public comp, right? That's a publicly traded company whose margins are incredibly, good. They're 67%. We're not quite there yet, but they were able to kind of make that mental leap and say, okay, so you're not true SaaS or you're not true BPO. You're a different kind of hybrid business model, right? So I think that was incredibly effective and important to help them understand because a lot of VCs, they kind of invest in the same thing over and over and over again, right? So I think it's up to us as the entrepreneur to really educate them on, you're not seeing this correctly, right? Let me walk you through why you're not, and here's the data to prove that, right? So it was a real problem we had, so we overcame it.
I'll keep working with the mic here. So.
Yeah.
Hi guys. It sounds like all of you have had to leave town basically to do a good amount of your fundraising, which makes sense. I was born and raised here in Miami, and I'm very interested in developing the ecosystem here in Miami and keeping a lot of sort of the wealth that you guys are helping to generate here in the local community. And I was wondering if you could comment at all on some of the challenges of finding investors here in the local ecosystem and sort of the outlook you see for that issue, and sort of the direction that's going.
Finding investors here locally? Well, I think when you're getting started, that's one thing Miami has a lot of. I think we have a lot of early stage capital. So if you want to get going, you want to raise $500,000, $1 million, there's a lot of angel investors here. And the good news is more and more of them are becoming educated in technology. Technology, I have this thesis, like everybody's like, is Miami a tech scene? Is Atlanta a tech scene? So everybody's going to be a tech scene. You need technology to run these days. Technology is a natural extension of business, and people are going to be investing money in technology. People that made their money in real estate and Wall Street, they're looking towards technology as the future, and I think Miami is benefiting from that. A lot of real estate money has gone into tech. And will continue. So I think one of the things that Miami does have figured out, we have a lot of affluent individuals here that are interested in early stage startups. A good thing that Miami has going for us is that, of course, because our living expenses are lower when compared to a Silicon Valley and a New York, et cetera, and because obviously that translates to salaries. There are less salaries because people can live on lower salaries here versus living in the Valley. You can have a lower money invested in a startup and have longer runway. Naturally, valuations will come down a little bit too. So I've seen money come in from elsewhere because valuations are much more appetizing here in South Florida versus Silicon Valley in New York. So they are here. I think you're in great places to meet investors, places like Building, go to places like the Lab, keep going to refresh events, shameless plug. And yeah, just keep networking. There are people here, and ask people that have done it, that have raised money for introductions. Like, please email me if you're working on a startup. Be happy to forward your deck to investors you think would be a fit, and I'm sure other people, in the scene will do the same. So, ask and you shall receive.
Yeah, we've raised $6 million, and $5.5 million of it has been in South Florida.
Yep.
Yeah, hi. Great talk, by the way. This is really interesting. In my own experience, I saw a very big difference between seed funding, angel funding, and then Series A. For me, it's like you're crossing this wall, this big difference. Seed investing, angel investors, in some cases, it might be a year before you even have a contact with them. They're typically very passive. But once you cross that wall into Series A and beyond, your lead investor, at the very least, becomes very active. Mm-hmm. And I'd love if you can maybe talk about what that experience was like in terms of how it became active, what the interaction was like with those lead investors, and even if maybe that meant changes to your board or changes to your executive team.
Yeah, so I'll take this one. So, not all money is great money, right? I think we talked about that. One of the risks that you run with angel investors is this is a huge generalization, but their main job, if you will, so to speak, for high net worth individuals is not necessarily, investing in companies and risking that, right? 1 in 10 of VC companies don't make it, right? Or rather, 1 in 10 make it. So the one thing that I would caution is that on the angel investment side, it's hard to find highly sophisticated investors, right? So what I have found, and we've been fortunate that this hasn't been the issue for us, but in other startups that I know, those angel investors are very active because they're calling saying, when's my return? When's my return? When's my return? Right? Versus an angel versus a VC, in essence, when we took on Norwest and Intel, Intel became a board observer and Norwest was actually on the board. So, they became very, very interested in how we were going to scale the business. They weren't necessarily concerned about what's my return looking like, this quarter, next quarter, et cetera, right? I think the point there is that they've invested in our A, in our B, in our C, pro rata. All of our investors have. So we've been very fortunate. But I think the difference is that the seed guys are all about, buying into that vision. And where the A, at least for us, what we saw was that they were very focused on how are you going to make this scalable and repeatable, right? And then let us connect you to our different portfolio companies that have done it. And yes, it did mean some turnover in our executives, with some of our execs, right? So,
if I may add, it goes back to what we said before. Choose very good who's your investor. We didn't have that feeling in our Series A because we chose somebody that we would have invited to the board even if she was not investing. She was a coach, a mentor, and all the time she was, how can I help? It was not about the money. It was about growing the company and how she can be a resource to us. And that good decision on our end was to pick the right investor for Series A. It was not the kind of investor that wanted the return 12 months after and high return. No. It was a fit for us. And that is my highest recommendation is do the interview and make sure that you marry with the right investor because that's a relationship that is going to be huge for your company. It's not just money. It's a very deep relationship.
Yeah, and I think that oftentimes what happens with entrepreneurs, especially founders or whatever the case may be, they feel like they can't ask for advice, right? What I would highly recommend is that you're incredibly transparent with your board. You're incredibly transparent with your investors. If you don't know the answer to something, ask them. They've seen this 1,000 different times, right? So one of the things, this trap that I see a lot of entrepreneurs fall into is that they feel that if they ask the question or they don't know how to do something, that investor's immediately going to say, well, they're not fit for that job, right? So I would say that especially those early on Series A, they bet on you, right? So I would say, ask them for as much advice as possible.
So my business that I'm trying to start is non-technological. So how would I capitalize on that market of venture capitalists? It seems that, especially for people my age, millennials, that they're looking for the next Facebook or Twitter, technological business. So how do I capitalize on that?
One clarifying question. What industry is it in?
Food. I'm starting a baking company. I'm specializing in cakes, cupcakes, kind of the homey type of feel, So it doesn't necessarily fit the technological aspect. It's kind of going back to the classics, I guess you could say.
Love it.
Venture capital is not exclusive to technology. There's lots of different types of VCs that invest in food companies, and there are even some tech VCs that are starting to invest in food companies. We just talked about the coffee with the they raised $50 million. Coffee, blue bottle, right? Yeah. There's a few other ones, but yeah, it's not exclusive to tech. Ben, be self-aware. Do you want to raise millions of dollars right now on a proof of concept? Or maybe you want to start 1 or 2 franchises, prove that the model's profitable, get a better valuation for your company, and then raise money. You should, try to figure out the process and be methodical about it. But by all means, no, it's not restricted just to technology.
And the other thing is, not everybody wants to be a Facebook. You don't have to be a Facebook or a Twitter or to be a viable company. You can be a $10 million revenue company and be a perfect company.
Absolutely.
And you will find venture capitalists that are going to invest if that's your goal. So
I would just say that when you articulate your business plan, your concept, your pitch deck, that you're very clear on what the business fundamentals are and why it makes sense for them to invest in you, right? It doesn't have to be all about tech.
I don't think someone like Zach the Baker is venture back, but I bet they could be if they wanted.
Right.
I was going to say, My Ceviches, the Hugo Freshes, where do they get their money? Start looking at,
And Zach the Baker is a great example. He was just in, I forget, maybe it was the Herald, but he specifically states, I do not want to grow this past more than a few stores. He doesn't want to, and that's okay. That's great. He wants to run a simple business,
Yeah.
Absolutely. Jimmy Biggs.
Right.
Yeah. We're in Denver. We love him.
I think he said the last.
Yeah, thank you.
Of course.